If you have ever felt that your money disappears faster than it should, you are not imagining it. There is a reason. And the strange thing is that the same force that makes your paycheck feel weaker can make a small investing habit become stronger than many full-time jobs over time. That force is time. Time works against cash that only sits and gets spent. Time works against wages that rise slowly while prices rise faster. Time works against people who depend only on a paycheck in a world where groceries, interest rates, insurance, rent, homes, cars, and basic living costs keep moving upward. But time can also work for you if you own productive assets. If you invest consistently, if dividends are reinvested, if small amounts keep going in no matter what the headlines say, then time begins to change sides. That is the principle. Most people feel the pain of time before they understand the power of time. They notice the grocery bill, they notice the car loan, they notice the mortgage rate, they notice the paycheck that technically went up but still feels weaker. They notice that life costs more but their bank account does not feel more secure. That is the first half of the system. The second half is that the same calendar that slowly weakens uninvested money can quietly strengthen invested money. A dollar spent is gone, a dollar saved is safe for a while. A dollar invested in a productive system can begin producing more dollars. That is the difference. And this is why a habit as small as $35 a week matters more than most people think. $35 a week does not look like wealth. It looks like a small bill, it looks like lunch money, it looks like a subscription, coffee, gas, a few snacks, or something that disappears without leaving evidence. That is why most people underestimate it. The amount is small enough to ignore, but wealth is not built only from large amounts. Wealth is built when a behavior repeats long enough for compounding to become visible. The beginning always looks unimpressive. That is why most people quit. The human brain is linear. It wants a direct connection between effort and result. If I put in $35, I want to see a meaningful change. If the account only moves slightly, the brain says this is not working. If the market falls, the brain says maybe I should wait. If inflation rises, the brain says I cannot afford to do this now. If the account is still small after the first year, the brain says what is the point? That is the wrong measurement. In long-term investing, the first question is not, did this change my life this week? The first question is, did I make the deposit? The second question is, did I keep the system alive? The third question is, did I allow time to keep working? Those are the questions that matter, because in the early years, the progress will not look dramatic. The snowball is still small, the compounding base is still forming, the dividends are still modest. The weekly deposits are still doing most of the work. But if the habit survives long enough, the balance begins to behave differently. The portfolio begins to produce income. The reinvested income buys more shares. The additional shares produce more income. The weekly deposits land on a larger base. The base grows faster. Then the curve begins to bend. That is compounding, and that is why $35 a week can eventually matter more than a raise that disappears into higher prices. To understand why this matters now, look first at inflation. Food is the simplest example because everyone feels it. Since 2020, food prices rose year after year. The source shows increases of 3.45%, then 3.94%, then a painful 9.95% in 2022, then 5.76% in 2023, 2.26% in 2024, and 2.45% in 2025. Put in plain terms, the $20 of groceries you bought in 2020 cost about $25.32 in 2025. That is not abstract. That is life. People do not experience inflation as a chart. They experience it when the same cart costs more. They experience it when a grocery trip that used to feel normal now feels like a calculation. They experience it when they check out and wonder what happened. They experience it when they buy less but still pay more. That is what inflation does. It does not always announce itself as a crisis. It changes the normal cost of living. It makes the same paycheck carry less weight. It turns yesterday's comfortable budget into today's tight budget. At the same time, borrowing became more expensive. Interest rates moved from near zero in 2020 to around 4.09% by late 2025 in the source framework. That makes mortgages heavier. It makes car loans heavier. It makes credit cards more dangerous. It makes any borrowed dollar more expensive to carry. So the person who has no investments and depends only on wages faces pressure from both directions. Prices rise, debt costs more, and wages do not fully catch up. The source points to wage growth around 3.8% in 2025. That may sound like progress, but if prices have already moved far higher since 2020, a 3.8% wage increase does not fully restore lost purchasing power. It may keep you from falling further behind that year, but it does not automatically repair the accumulated damage. This is the trap of relying only on salary. Your paycheck may rise, but costs may rise too. Your income may grow, but not enough. Your employer may give a raise, but inflation may take most of it before it reaches your life. That is why a paycheck alone is a weak financial engine. It is necessary, it is important, it is how most people begin. But it is not enough if you want to build freedom. The paycheck is active income. It requires your time. It requires your labor. It stops if you stop working. Investments are different. They are ownership. If you build them over time, they can begin growing even while you sleep, work, raise a family, recover from illness, or sit through another confusing year in the economy. This is the difference between being paid only for effort and being paid because you own a piece of productive assets. Now, the stock market frightens people because they remember crashes. That fear is understandable. Markets have had major declines: the Great Depression, the dot-com crash, the 2008 financial crisis, the COVID crash in 2020, the inflation-driven decline in 2022. Every one of those moments felt serious in real time. People were afraid. Headlines sounded final, experts disagreed, prices fell, portfolios dropped. It felt as if the system might not recover. But when you zoom out, another pattern appears. The market has had major crashes, but over the long term it has continued trending upward. That does not mean it rises every year. It does not mean every investor earns the long-term return. It does not mean every fund or stock survives. It does not mean risk disappears. But broad ownership of productive companies has historically rewarded patience, reinvestment, and consistency. Long-term market return research often places broad market returns around 10 to 11% per year, including dividends. The exact return varies depending on period, index, inflation, fees, and behavior. But the principle is strong. Over long periods, productive ownership has tended to grow faster than wages and cash. This is why weekly investing works. You do not need to know whether inflation will be high next month. You do not need to call the market top. You do not need to buy the perfect dip. You do not need to outsmart every economist, central banker, fund manager, and algorithm. You need a system that keeps buying through uncertainty. If prices rise, the weekly deposit still goes in. If prices fall, the weekly deposit buys more shares. If markets recover, those shares participate. If dividends are paid, they are reinvested. If the economy feels chaotic, the habit continues. This is powerful because consistency is one of the few things the ordinary investor can control. You cannot control food prices. You cannot control interest rates. You cannot control whether the Federal Reserve cuts or raises. You cannot control whether the market sells off this month. You cannot control headlines. You can control whether you invest this week. That is the key. The habit may be small, but the control is real. Now, this connects directly to the idea that investments can eventually surpass a full-time job. At first, that sounds exaggerated. How can $35 a week create more income than a job? The answer is time compounding, reinvested dividends, and a portfolio large enough that its income production becomes meaningful. A paycheck grows slowly. A long-term portfolio, if built consistently and allowed to compound, can grow at a rate that is often 2 or 3 times wage growth. At the beginning, that difference barely matters. Later, it matters enormously. A 10% return on $1,000 is $100. A 10% return on $10,000 is $1,000. A 10% return on $100,000 is $10,000. A 10% return on $1 million is $100,000. Same rate, different life. That is the math most people never internalize. The goal is to build the base. Once the base becomes large enough, the same return percentage creates income and growth that can rival or exceed a salary, but the base is not built overnight. It is built through repeated deposits that look too small to matter at first. Let's look at the snowball effect. Suppose someone invests only $20 per week. That is $1,040 per year. For many people, that amount feels too small to take seriously. But in the first year, it creates the first layer of the snowball. Nothing dramatic happens yet. The account grows a little, dividends may be reinvested, the balance begins forming. By year 3, the person has contributed $3,120. With market growth and reinvested dividends, the balance may be around $3,750 in the source example. The extra amount above contributions is the early snowball. It is still small, but it is real. By year 5, contributions reach $5,200, while the account may be closer to $6,850. The gap between what the person contributed and what the portfolio is worth becomes more visible. The portfolio has begun to help, not dramatically. Not enough to replace income, but enough to prove that the process is alive. This is how compounding starts. At first, almost everything comes from your deposits. Then a little comes from growth. Then more comes from reinvested dividends. Then the portfolio begins creating a larger portion of the new wealth. That shift is slow, and then it becomes powerful. This is why the first few years are so psychologically difficult. The work is visible, the reward is quiet. You invest every week and still do not feel rich. You make the deposit and the market may fall. You reinvest dividends and the income still looks small. Your brain judges the early stage too harshly. This is the mistake. The early stage is not supposed to look explosive. It is supposed to build the base that makes the later explosion possible. A person who stops because the first 5 years look boring never reaches the part where compounding becomes visible. That is why the mindset is as important as the math. Most people do not fail at weekly investing because they cannot understand it. They fail because the early result feels too small to respect. They measure the wrong thing. They ask, is my balance growing fast enough? A better question is, did I invest this week? That question is under your control. You cannot control the market this week. You cannot control the news this week. You cannot control inflation this week, but you can control whether the habit happened. This changes the psychology. It takes the pressure off immediate results and puts attention on consistency. The person who stays consistent gives the portfolio time to move from small to meaningful. The person who waits for the perfect moment may never begin. The person who quits during volatility never lets the curve develop. This is why the routine matters. In a world of uncertainty, a routine is a form of power. Now, once the mindset is in place, the next question is what to buy. The source focuses on Fidelity index funds. The exact funds are less important than the criteria behind them, but the structure matters because it shows how a long-term portfolio can combine growth, income, diversification, and low fees. The first criterion is diversification. Diversification means not depending on one company, one idea, or one outcome. If you own only one stock and that company fails, your portfolio can be damaged badly. If you own hundreds or thousands of companies through broad funds, one company's failure does not destroy the whole system. A broad index fund spreads risk. One company can struggle. Another can grow. One sector can cool down. Another can lead. The portfolio survives because it is not built on a single prediction. This is extremely important for weekly investing because the goal is not to win one trade. The goal is to keep accumulating ownership over decades. A durable system must survive mistakes, recessions, market rotations, and unexpected events. Diversification helps. The second criterion is broad exposure. Diversification means owning many companies. Exposure means understanding what kinds of companies you own. Large companies behave differently from mid-sized companies. Growth companies behave differently from income-oriented companies. Sustainable and future-focused companies may behave differently from traditional sectors. Some years large caps lead, some years mid caps do better, some years dividend growers stabilize the portfolio, some years technology drives returns. A strong portfolio does not rely on only one kind of company. It spreads across sizes, sectors, and styles. That gives the investor more ways to participate as the market rotates. The third criterion is real historical performance. You do not want only a good story. You want funds backed by underlying companies that have shown the ability to grow, earn, pay, and survive. Hype can move prices for a while, but long-term compounding depends on business performance. This is why broad funds can be useful. They give exposure to many businesses without requiring you to choose the few that will win. The fourth criterion is dividend growth. Dividends are often underestimated by newer investors. A dividend is not just income. If reinvested, it becomes a compounding engine. The fund pays a dividend, the dividend buys more shares. The new shares produce more dividends. If the underlying companies grow dividends over time, the income stream can grow too. Dividend growth strengthens the snowball. It adds another layer to compounding. The fifth criterion is low fees. Fees are quiet, but they are powerful over decades. A small fee difference may not look large in 1 year. Over 30 years, it can take a meaningful portion of the return. Low fee or zero fee funds keep more money inside the compounding system. This is one reason index funds are attractive. They are simple, they are diversified, they are low cost, they can be held for decades. They remove many ways investors sabotage themselves. That does not mean every index fund is perfect. It means a low cost diversified fund is often a strong building block for ordinary investors. Now, the source uses 5 Fidelity funds in a simple equal weighted portfolio. The first is FZROX, the Fidelity Zero Total Market Index Fund. This is the core. It is a broad United States total market fund. It owns large, mid, and small companies across major sectors. Its purpose is simple: track the broad United States stock market with zero management fees. A fund like this gives the portfolio its foundation. It does not try to predict one winning company. It owns the market in the source framework. FZROX has a yield of 1.04%, dividend growth of 7.55% per year, and annual price appreciation of 13.5%. Those numbers make it a growth-oriented core in the portfolio. The second fund is FSMDX, the Fidelity Mid-Cap Index Fund. Mid-sized companies occupy an interesting place in the market. They are not as small and fragile as the youngest businesses, but they can still have more room to grow than the largest companies. They may be in the expansion phase of their business life. In the source framework, FSMDX holds around 300 companies across areas such as technology, industrials, consumer sectors, and financials. It has a yield of 2.42%, dividend growth of 17.21%, and annual appreciation of 7.4%. Its role is to add expansion potential. The third fund is FITLX, the Fidelity U.S. Sustainability Index Fund. This fund adds a modern growth tilt. It invests in companies screened for environmental, social, and governance practices, with exposure to areas such as technology, healthcare, and communications. The source frames it as a way to own companies shaping the future while still maintaining an index. Like structure in the source framework, FITLX yields 1.14%, grows dividends at 13.74%, and delivers annual appreciation of 13.06%. Its role is future-oriented resilience and growth. The fourth fund is FGRIX, the Fidelity Growth and Income Portfolio. This fund brings balance. It invests mostly in high-quality, large-cap companies with stable earnings, combining dividend income with growth. That is useful because a portfolio should not depend only on aggressive appreciation. It should also have components that can pay and grow at the same time. In the source framework, FG yields 3.13%. Has dividend growth of 19.68% and annual appreciation of 8.17%. Its role is to lift both sides of the system, income and growth. The fifth fund is FDGFX, the Fidelity Dividend Growth Fund. This is the income stabilizer. It focuses on companies with histories of raising dividends and strong financial fundamentals. It is not positioned as the fastest rising part of the portfolio. Its role is to strengthen the income side and make the compounding loop steadier. In the source framework, FDGFX yields 3.2%, grows dividends at 18.03%, and has annual appreciation of 2.78%. Its role is dividend stability and long-term income growth together. These five funds create a portfolio that covers broad market ownership, mid-cap expansion, sustainability, oriented growth, and dividend growth. The point is not that this is the only possible portfolio. The point is that the structure is logical: core expansion, modern growth, balanced income, dividend growth. That is a system. Now, the source uses a simple equal-weighted calculation to estimate portfolio metrics. Each fund is treated as 1/5 of the portfolio. To estimate the average dividend yield, it adds the yields of the five funds: FZROX at 1.04%, FSMDX at 2.42%, FITLX at 1.14%, FGRIX at 3.13%, FDGFX at 3.2%. Together, that total is 10.93 divided by 5, and the average portfolio yield is 2.186%, rounded to 2.19%. That is the first metric using the same simple average method. The source calculates average dividend growth of 15.24%. An average annual share price appreciation of 8.98%. These numbers form the projection base. Now, projections are not guarantees. That should always be understood. A model is a way to think, not a promise from the future. Markets do not deliver exact averages on schedule. Dividend growth can slow. Funds can change. Economic conditions can change. Valuations can reset. Inflation can pressure returns. Past performance does not guarantee future performance. But projections can still be useful if they teach the mechanics. They show how small deposits, growth, dividends, and time interact. The model is not a certainty. It is an illustration of compounding. That is the correct way to use it. Now, let us look at Josh S. example. Josh invests $5 per Dalton Y. That is $35 per week. Because the model uses 5 funds, that is roughly $1 per Dalton Y into each fund. This sounds almost too small to matter, and that is the point, $5. Per Dalton Y is easy to dismiss. Many people spend that without noticing, but if the money is invested every day or every week instead of disappearing into consumption, it begins building a compounding base. By the end of year 1, Josh contributes about $1,825. That is the foundation. Still not dramatic, but it is real ownership. By year 10, the portfolio is projected at around $32,000. Now the account is no longer invisible. The weekly habit has produced a real asset. Dividends have begun adding momentum. The account has started to matter. By year 20, Josh has contributed about $36,500 in total, but the portfolio is projected to reach around $160,000. That is where compounding becomes far more visible. The portfolio may be generating nearly $9,000 per year in dividends according to the source model. At that point, the portfolio is no longer a small side habit. It is a meaningful income, producing asset. Then the final decade shows why time matters so much. By year 30, Josh's portfolio is projected to reach around $942,000. The dividend income projection reaches around $98,000 per year, or about $8,000 per month. That is the moment where the title becomes real. A $35 weekly habit can build an asset base that pays more than many full-time jobs. Not because Josh was rich, not because he timed the market, not because he picked one perfect stock, not because he outsmarted everyone, because he kept buying, because dividends were reinvested, because time was allowed to work, because compounding had 3 decades. Over those 30 years, Josh contributed $54,750 out of pocket. The future portfolio value in the source projection is $942,000. Subtract the $54,750 contributed, and roughly $887,250 would be created by compounding, reinvested dividends, and market growth. That is the lesson. Most of the future wealth does not come directly from the money Josh put in. It comes from what the money did after it was invested. That is ownership, and it is very different from wages. With wages, if you stop working, the income stops. With a portfolio, if built correctly over time, the assets can continue producing income. That is why investing can surpass a job. Not immediately, not easily, not without risk, but mechanically the money becomes workers. The workers produce more workers. Eventually, the workers can produce income on a scale that a small weekly habit could never have produced by itself. That is the power of compounding. Now, there is an important psychological lesson in the Josh example. The first 10 years matter, even though they do not look explosive. Many people would look at year 1 and see only $1,800. They would say, this is too slow. They would quit. They would use the money for something more immediately satisfying. But the first 10 years are not supposed to create the full result. They are supposed to create the base. Year 10 supports year 20. Year 20 supports year 30. That is how compounding works. The final decade often produces the most dramatic increase because the balance is finally large enough for growth to be powerful. But the final decade cannot happen without the first decade. People want the final decade without the first. That is impossible. You cannot harvest a tree you never planted. You cannot receive dividend income from shares you never bought. You cannot benefit from compounding if you keep interrupting it. This is the discipline. Now, let us connect this to inflation again. Inflation makes life feel harder, but it also creates urgency to own assets. If prices rise over time and wages lag, then holding only cash and relying only on salary can make a person weaker. But owning shares of companies can give exposure to businesses that may raise prices, grow revenue, increase dividends, and participate in the expanding economy. That does not mean stocks protect perfectly from every inflation environment. They do not. But over long periods, productive assets have generally been a better inflation defense than idle cash. This is why weekly investing is not only about getting rich, it is about defending purchasing power. Every week you invest, you are converting a small piece of earned income into ownership. That ownership may grow faster than wages. That ownership may pay dividends. That ownership may benefit from productivity, innovation, and corporate earnings. That is how you move from being only a consumer to being an owner. This is one of the most important transitions in personal finance. Consumers are hurt by rising prices. Owners can sometimes benefit from rising revenues and assets. You want to be both, because everyone consumes, but you do not want to be only a consumer. You want ownership, even small ownership, even $5 a day. Now, the market crash history helps answer the fear question. What if the market falls? It will. Not maybe it will. The market will fall at some point. It may fall 10%, it may fall 20%, it may fall more, it may recover quickly, it may take time. Headlines will be scary. People will say this time is different. Some companies will fail. Some sectors will struggle. Some investors will panic. That is normal. The weekly investing system does not depend on avoiding all crashes. It depends on continuing through them. If the market drops while Josh is still accumulating, his $35 buys more shares. Lower prices are not only pain for an accumulator, they are also opportunity. The person who keeps buying through downturns can benefit when recovery comes. This is why timing the market is not necessary for most long-term investors. Timing requires being right twice. You must know when to get out. Then you must know when to get back in. Most people cannot do that consistently. A weekly investing system avoids that trap. It says, I will keep buying through the cycle. That does not eliminate risk. It removes the need for perfect prediction. And removing the need for perfect prediction is one of the most valuable things a normal investor can do. Now, let us talk about dividends. Dividend income is psychologically powerful because it shows that ownership pays a stock or fund rises and falls in price. But a dividend is cash flow from ownership. When reinvested, it buys more shares. When those shares produce dividends, the loop strengthens. Dividend growth is especially powerful because the income stream itself can rise over time. A fund that owns companies raising dividends can produce a growing cash flow. When that cash flow is reinvested for decades, it accelerates the accumulation phase. This is why the source emphasizes the average dividend growth rate. The starting yield is only one part of the story. A high yield with no growth may be less attractive than a moderate yield with strong growth. A low yield with strong appreciation may also play an important role. That is why the 5-fund structure combines different roles rather than chasing only the highest current yield. If you chase yield alone, you can make mistakes. Some high yields exist because the market expects trouble. Dividends can be cut. A high payout can be unsustainable. A fund or company with weak fundamentals can lure investors with income and then damage capital. A good income strategy should ask where the dividend comes from. Is it supported by earnings? Is there growth? Is there stability? Is the portfolio diversified? Are fees low? Is the yield realistic? These questions matter. Now let us talk about fees more deeply. A fee is a small leak in the compounding machine. If a fund charges high fees, those fees reduce the amount left to grow. In 1 year, the difference may feel small. Over 30 years, it can be very large. This is why a zero-fee or low-fee index fund can be attractive. The lower the fee, the more return remains inside the portfolio. That does not mean every low-fee fund is automatically good. The fund still needs the right exposure and strategy. But in broad index investing, fees are one of the easiest variables to control. You cannot control market returns. You can control cost. And when you cannot control everything, you should control what you can. Now, the source uses Fidelity funds specifically. The deeper principle is broader than the brand. A strong long-term portfolio should be diversified, low cost, simple enough to maintain, and built around productive assets. Fidelity is one possible platform. Other platforms have similar tools. What matters is that the investor understands the structure and stays consistent. A portfolio is only as good as the behavior attached to it. A person can own good funds and still fail if they stop contributing, panic sell, chase performance, or constantly switch strategies. The funds matter, the behavior matters more. Now, let us consider the equal weighting assumption. The source uses a simple average across 5 funds as if each fund receives the same allocation. That is useful for illustration in real life. A person may choose different weights. They may want more broad market exposure through the total market fund. They may want less concentration in funds that overlap. They may want a different income, growth balance. They may adjust based on age, risk tolerance, tax situation, and goals. The example is not a command, it is a model. The purpose is to show how a small weekly amount can be spread across a diversified structure and allowed to compound. This is important because new investors often believe they need complexity. They think investing requires 20 funds, daily research, technical charts, predictions, options, or constant rebalancing. It does not have to. A small set of diversified funds can be enough to start building the habit. Complexity is not the same as intelligence. Sometimes simplicity is what makes the system durable. Now let's think about risk. A portfolio that grows toward $942,000 in a projection does not move there in a straight line. There will be bad years. There may be long periods where the balance feels stuck. Dividend growth can slow. Funds can underperform some years. The account may fall even though contributions continue. This is why the investor must understand the difference between volatility and failure. Volatility is the market moving around. Failure is abandoning the plan without a good reason. If the portfolio is diversified and aligned with long-term goals, volatility is expected. It is the price paid for the possibility of higher long-term returns. A person who cannot accept volatility may need a different allocation, but a person who wants the long-term compounding power of equities must understand that volatility is part of the experience. You do not get the long-term return without living through short-term discomfort. That is the bargain. Now, there is another important issue: taxes. If the funds are held in a taxable account, dividends may create taxable income. Capital gains may be taxed when shares are sold. Tax efficiency matters. If the funds are held in tax-advantaged accounts such as a Roth IRA, traditional IRA, 401k, or similar account, the tax treatment changes. The source does not rebuild the portfolio around tax strategy. But a serious investor should understand account location. Long-term compounding can be stronger when taxes are managed intelligently. If possible, use retirement accounts where appropriate. Capture employer matches, understand contribution limits, use taxable accounts when needed for flexibility. Again, the system matters. The investment is one piece, the account type is another, the behavior is another, the time horizon is another. A good wealth plan connects them. Now, let us return to the idea of a portfolio paying $8,000 a month. That is powerful because it changes how a person thinks about work. The goal is not necessarily to quit working immediately. The goal is to create options. If a portfolio produces meaningful income, work becomes less desperate, choices expand, a person can change jobs, retire earlier, care for family, work part-time, take business risk, or simply feel less trapped. Money gives options. Portfolio income gives ongoing options. That is why the idea matters. But the monthly income does not appear in the first year. It appears after decades of accumulation, reinvestment, and discipline. That is why the habit must begin while the result still feels far away. The gap between action and reward is what tests people. The investor who understands the gap survives it. Now, why is $35 a week psychologically easier than a large annual deposit? Because it fits real life. Many people cannot imagine investing thousands at once, but $35 per week may be possible. It can be automated, it can be treated like a bill, it can be small enough to continue during normal life. Weekly investing also reduces timing anxiety. If you invest once per year, you may worry whether the day is right. If the market drops afterward, you feel regret. If you invest weekly, no single purchase carries much emotional weight. Some purchases will be high, some low over time. The cost averages out. This is the benefit of dollar cost averaging. It trades perfect timing for consistent participation. And for most people, consistent participation is more valuable than trying to be perfect. Now, the key is to automate. If Josh has to manually decide every day or every week, the plan is vulnerable. Motivation fades. Life gets busy, the market scares him. Something else feels urgent, the money gets spent. Automation removes that decision, the weekly amount goes in, the funds are purchased, dividends are reinvested, the system continues, the less often a person must decide. The fewer chances emotion has to interfere. This is why automatic investing is so powerful. It converts intention into behavior. Intentions do not compound, behaviors do. Now, if $35 a week feels too high, start smaller. The source discusses even $20 per week. The principle is not that 35 is magical. The principle is consistency. If you can start with $5 per week, start. If you can do 10, do 10. If you can increase later, increase. The habit matters first. But once income rises, increase the contribution. Do not let lifestyle absorb every raise. If wages grow 3 to 4% and prices rise too. The temptation is to spend every increase just to maintain lifestyle. But if you direct part of every raise into investments, you begin widening the gap between paycheck and future wealth. This is how ordinary people build capital. Small start, regular increase, long time, low fees, reinvestment, discipline. There is no drama in that formula. That is why it works. Now, some people will say the projections are unrealistic because dividends and growth may not continue at those rates. That concern is valid. Projections can be too optimistic, returns may be lower, dividend growth may slow, a portfolio may not reach the exact number, the monthly income may be lower. But that does not destroy the core idea. Even if the final number is lower than projected, the person who invests $35 per week for 30 years will likely be in a far better position than the person who invests nothing because the projection was uncertain. Uncertainty is not an excuse for inaction. It is a reason to use conservative assumptions, diversify, and keep going. The future is never guaranteed, but doing nothing has its own guarantee. No compounding. Now, let us think about the opportunity cost of not investing. $35 a week spent casually may create no lasting asset. It may buy convenience, entertainment, or small comforts. There is nothing wrong with enjoying life, but if every small amount disappears, the future never gets funded. $35 a week invested becomes ownership. 1 week is small. 1 year becomes 1,820. $5 10 years becomes a meaningful account. 30 years becomes potentially life-changing. The difference is not the amount, it is the direction. Spending moves money out of your system. Investing moves money into an ownership system. The same dollar has different consequences depending on where it goes. That is why tracking small amounts matters. Not because you should become miserable over every purchase, but because repeated small decisions create large outcomes over time. Now, what does the portfolio actually represent? FZROX represents broad United States ownership. FSMDX represents mid-cap expansion. FITLX represents sustainability, screen companies, and modern sectors. FGRIX represents large cap growth and income. FDGFX represents dividend growth and income stability. Together, the funds represent a mix of growth and income. The portfolio is designed to appreciate and increase payouts. The weekly investment buys into all parts of that system over time. The investor owns more shares across the funds. Those shares may rise in value and produce dividends. The dividends buy more shares. The process repeats. That is the machine. Once you understand the machine, the weekly deposit no longer feels small. It feels like fuel. Now, let's talk about comparing portfolio income to a job. A full-time job pays you because you show up and perform work. A portfolio pays you because you own assets. At first, the job is much larger. The portfolio income may be pennies or dollars, but the portfolio has a different nature. It can grow from reinvestment and appreciation. It can keep producing while you sleep. It does not need you to clock in. That does not make it risk. Free dividend income can change. Market values can fall. Funds can underperform. But the difference between labor income and ownership income is still profound. A person who has only labor income is always vulnerable to job loss, health problems, burnout, industry changes, and age discrimination. A person who also has ownership income has another engine. The goal is not to despise work. The goal is to stop being entirely dependent on work. That is why building a portfolio matters. Now, the source says the portfolio can eventually pay over $8,000 per month. Whether the exact number happens depends on the assumptions. But the deeper point is that income can become meaningful. Once portfolio income reaches even $500 per month, life changes. At 1,000, more changes. At 3,000, options expand. At 8,000, the portfolio can rival a strong job. The first dollar of portfolio income is not financially large. It is psychologically large. It proves that money can work. The later dollars become financially large. That is the journey. Now, how does a person stay steady for 30 years? They need a principle, not just motivation. The principle is that short-term noise is not the same as long-term direction. Inflation headlines will come, rate headlines will come, recession warnings will come, election fears will come, crash predictions will come, market euphoria will come, market panic will come. None of that should automatically stop the weekly system. If your financial life changes seriously, adjust. If income falls, reduce contributions temporarily. If an emergency happens, use the emergency fund. If the portfolio no longer fits your goals, review it thoughtfully. But do not stop because the market had a bad week. Do not stop because the account is boring. Do not stop because the balance is still small. The habit is the asset before the portfolio becomes the asset. Now, this is also why broad funds are psychologically useful. If you own one company and it drops, you may panic. You have to ask whether the thesis broke. You have to understand management, competition, earnings, valuation, and risk. With broad funds, you are investing in a system rather than one company. You still need to understand risk, but you do not need to predict one winner. That makes the habit easier to maintain. A beginner needs a strategy they can hold. If the strategy is too fragile emotionally, it will fail. Now let's discuss reinvested dividends. Some investors take dividends as cash immediately. In retirement, that may make sense, but during accumulation, reinvestment is powerful. A dividend taken in cash can be spent. A dividend reinvested buys more shares. Those shares create more future dividends. This is compounding inside compounding. Josh's projection relies heavily on reinvested dividends. If he spent the dividends instead, the final portfolio would likely be much smaller. This is why the accumulation phase requires discipline. You let the income feed the machine until the machine becomes large enough to serve you. Do not eat the seed corn too early. Let it grow. Now, the Source S portfolio has an average dividend yield of 2.19%, but projected income becomes much larger over time because dividend growth and share accumulation work together. The current yield is not the whole story. The number of shares grows, the dividends per share may grow, the account value grows, eventually the dollar income becomes large. This is why early income can be misleading. A small account with a 2% yield pays almost nothing. A large account with a 2% yield pays meaningful money. If the yield grows over time, even better. Again, build the base is everything. Now let's consider someone who is already older. If you do not have 30 years, does the strategy still matter? Yes, but expectations should change. A 30-year time horizon gives compounding tremendous room. A 10-year horizon is different. The same weekly deposit will not produce the same result, but consistency still helps. Investing still matters. Dividend growth still matters. The portfolio still can improve your future. The lesson is not to pretend every person has 30 years. The lesson is to start from your actual point and use the time you have. If you are younger, do not waste the time advantage. If you are older, do not let regret prevent action. The best time to start may have been years ago. The next best time is the first week you can do it responsibly. Now, what if the person has debt? If you have high-interest credit card debt, that debt may need priority. Paying 20% interest while investing small amounts in the market may not make sense. The guaranteed cost of high-interest debt is too high. Build a basic emergency cushion, attack toxic debt, then invest. If the debt is low interest and manageable, weekly investing can run alongside it. The financial order matters high. Interest debt is an emergency. Low-cost debt is a planning question. Investing is the compounding engine. Cash is the safety system. A good plan balances all of them. Now, the $35 per week habit should not be built on overdrafts or stress. If the money truly cannot be spared, first stabilize the budget. But many people can find $35 if they examine spending carefully. Small leaks often exist. Subscriptions, impulse purchases, convenience spending, food delivery, forgotten recurring charges, unused services. The goal is not shame. The goal is redirection. Take money that was disappearing and give it a job. That is the essence. Now, let us think about income replacement. If a portfolio eventually pays $8,000 per month in dividends in the projection, that is $96,000 per year. That is more than many full-time jobs, but it took 30 years of consistent behavior. That is the part people must not ignore. The headline is exciting. The discipline is the price. The mistake is wanting the income without respecting the time. There is no shortcut in the source structure. Josh does not gamble into the result. He does not time perfect crashes. He does not use leverage. He does not chase one hot stock. He invests a small amount consistently into a diversified Fidelity fund portfolio and lets the process run for 3 decades. That is the lesson. Boring can become powerful. Now, I want to talk about why the first 5 years are the hardest. In the first 5 years, the balance is still small, and every headline feels bigger than the account. If the account drops by 10% when the balance is $5,000, the dollar decline may not be huge, but emotionally it can feel discouraging because the investor has been working hard for a small base. They may think the market is taking away their progress, but a downturn in the early phase can actually help if contributions continue. The weekly dollars buy lower price shares, the investor accumulates more ownership. Later, if markets recover, those shares matter. The danger is not the downturn. The danger is stopping. This is why the weekly investor must expect volatility before it arrives. If you expect smooth progress, every downturn feels like betrayal. If you expect volatility, downturns become part of the plan. Now, there is another subtle advantage to weekly investing. It builds identity. A person who invests every week begins thinking like an investor. They notice the market differently. They pay attention to funds, dividends, fees, inflation, and compounding. They become more aware of spending. They begin seeing money not only as something to spend, but as something to deploy. That identity shift matters. You become the type of person who owns assets. That identity can lead to larger contributions, better decisions, more learning, and greater confidence. The first deposit is financial. The repeated deposit is psychological over time. Both compound now. The source emphasizes fidelity, but the fundamental criteria can be used anywhere. Look for diversification. Look for broad exposure. Look for historical strength. Look for dividend growth. Look for low fees. Look for a structure you can understand. Look for something you can hold through volatility. A portfolio should not be so complicated that you abandon it. It should not be so concentrated that one mistake destroys you. It should not be so expensive that fees consume compounding. It should not be so speculative that you cannot sleep. A good long-term portfolio is often simple, diversified, and durable. That is not exciting on day one. It is powerful on year 30. Now let's examine the difference between price appreciation and dividend income. Price appreciation grows the value of the portfolio. If shares rise, the account becomes larger. Dividend income pays cash. If dividends are reinvested, they buy more shares. If dividends are taken later, they can support living expenses. The best long-term outcome can come from both. Funds that appreciate without much income can build wealth. Funds that pay income but do not grow can provide cash flow but may lose purchasing power over time. A combination can create balance. That is why the source portfolio mixes growth, income, and dividend growth rather than relying on only one dimension. This is a systems approach. Different parts do different jobs. Now, the source S calculation uses simple averages. A more precise analysis would use actual portfolio weights, actual fund histories, actual compounding assumptions, changing dividend rates, tax treatment, and future return uncertainty. But the simple method is useful for a YouTube audience because it shows the basic mechanics clearly. Add the yields, divide by 5, estimate the average. Use the average to project growth. The purpose is not academic precision. The purpose is behavior. If the viewer understands that $35 a week can become meaningful, the viewer may start. Starting is the critical step. A perfect model that never changes behavior is less useful than a simple model that motivates disciplined investing. That is an important point. Now, let us talk about staying realistic. No portfolio is guaranteed to turn $54,000 into $942,000. The future may be better or worse. Dividends may not grow as projected. Appreciation may be lower. Fees, taxes, or behavior can reduce returns. Some funds can change strategy or underperform. So the responsible interpretation is this. The projection shows what can happen when small weekly deposits, long time horizons, reinvested dividends, and market growth work together. It does not guarantee the exact result. That distinction keeps the lesson honest. The central truth remains. Consistency plus compounding can produce outcomes far larger than the contributions alone. Even if the final number is smaller, the habit is still powerful. Now, I want to connect this to the idea that money disappears. If you do not give money a job, modern life will give it one for you. A little more for groceries, a little more for gas, a little more for insurance, a little more for convenience, a little more for interest, a little more for subscriptions, a little more for impulse. By the end of the month, the money is gone and you cannot point to the asset it created. That is how people stay stuck. Weekly investing interrupts that pattern. It takes money before it disappears and turns it into ownership. That is why automation matters. If you wait until the end of the month to invest what is left, often nothing is left. If you invest first, the money has already been converted into an asset. Pay yourself first is an old phrase, but it is still true. In this context, paying yourself first means buying ownership before consumption absorbs the money. Now, how should someone begin today? Choose a weekly amount, pick a platform, choose a simple diversified portfolio, automate the deposit, turn on dividend reinvestment, track progress quarterly, not obsessively every day, increase the weekly amount when income rises, do not stop during normal volatility, keep an emergency fund so you are not forced to sell, avoid high interest debt, let time work. That is the system. If you can do $35 per week, do that. If you can do more, do more. If you can only do less, start with less. The amount can change. The habit is the beginning. Now, I want to close with the deepest principle. Your paycheck is linear. Your investments can become exponential. A paycheck is tied to hours, raises, promotions, and labor. It matters, but it usually grows slowly. Investments, if built in a disciplined way, can compound. The beginning looks small because the base is small. But over decades, the curve can become powerful enough to change your life. That is why time is both the enemy and the ally. If you only earn and spend, time makes life more expensive. If you invest and compound, time can make ownership more valuable. The same calendar does both. Which side you experience depends on your behavior. If inflation is raising grocery prices, if rates are making debt more expensive, if wage growth is not keeping up, then waiting does not help. You need a counterforce. Weekly investing is one of those counterforces. Not because $35 is large, because $35 repeated for 30 years is not $35 anymore. It becomes a system. A system becomes a portfolio becomes income becomes options become freedom. That is the chain. Most people dismiss the small beginning. Do not dismiss it. The first weekly deposit may look like nothing. The first year may look modest. The first 5 years may look boring. But the boring years are building the foundation for the decade where compounding finally starts to look obvious. And by the time everyone else sees it, the hardest part has already been done. The habit is already built. The shares are already owned. The dividends are already reinvesting. The market has already had years to work. That is how a small weekly habit can begin to surpass the income of a job. Not through hype, not through luck, not through perfect timing, through discipline, ownership, reinvested dividends, low fees, broad exposure, and time. That is the system. And the system begins the week you decide your money will stop disappearing and start working.